Hello, guys. Once again, I welcome you back. So, today I'm going to be responding to some of the questions that I received, and I'm going to address three issues. The first one was let me quickly respond to this one. He said, why can't he save, is not able to save the analysis that he does on TradingView, the one for binary, the saving the analysis, and was looking for the way. Now, for this one, the answer is simple. Apparently, this trading view, this one for synthetic indices, you cannot save your analysis. Basically, you can only do a one-time analysis, and then when you click off the tab, you will have to redo the analysis. You cannot keep it as of now, but I have hope that they will be updating it. That's why you cannot even trade on this one. You cannot place entries, but all you can do here is just to analyze, to do the analysis, and then hopefully, because they just use the trading view API, I think that's some good ICT. So they just use it, and hopefully they will upgrade it, hopefully. But if you take the entries, you go over on MetaTrader 5. So the next question was displacement. What is displacement? And then someone else was asking me what is the best time frame for swing trading. Now those are the two things that I'm going to talk about majorly: displacement and then swing trading. Now, let me start with displacement. Uh, what is displacement? To me, by the way, you shouldn't be scared by some of the words that I can mention here. I don't intend to scare you off and you think there's some magic in displacement, let's say, and you think it's a holy grail. No, in my opinion, displacement, these are terms that we are going to be using to describe the market. For instance, if you have like a friend, and then let's say you do analysis together, and then maybe he's away, you can be like, let's say you go and check out step index at this level. I'm expecting a displacement, and we are going to be looking at that. Now, personally, if you have, let's say, let me give an example. If you have a buy model, by a buy model, they are just a set of confirmations that you look at. For instance, let me illustrate something here that sometimes I look at. Let's say if at all the market has been in a downward trend like this, and then I see something like that. Actually, something like this. So I see that we've been breaking structures as we come down, but all of a sudden we come and break the structure above after breaking a structure here. You get? So personally, one of the things that could come to my mind is that possibly the market is reversing. Possibly it's a probability. It's not yet confirmed. That's why you have to have you have to have done some good analysis. Now, personally, I could mark up this area down here that possibly it could be an area of demand. It could be an area of demand. So I would be expecting to see how the market reacts to this zone. You get? So you zone out your market. Now, when I come in this zone, possibly I could see that the market reaches here, taps there, and then it comes to create what we've created a high, and then we create a higher high. And then here we have a low, then we create a higher low. Sometimes the market comes and creates what we call equal lows. Those are double bottoms. You get? Those are double bottoms. And then we have a higher high. So this is we can say if we get something like this, then we hope to be breaking areas of supply. So previous areas that were selling, we come and break, and we start getting impulse moves as we go up. Basically, that's the model. You get? Like, it's one of the confirmations, and then we can go further that uh, this kind of scenario that you're seeing over here, it could happen at any time. You get? At any point. For instance, you can analyze. Let's say we're on VIX 50s, and then we are in this zone. If you go on M1, apparently we're only 15. There could be something like this here. So we don't look at this kind of pattern. If you have a pattern, even it has to happen in a certain place where you expect, where like after you analyzing it. Now let me explain that more when I go. Let me delete these things, and then I go on the chart, and then I show you. So let's say I'm trying to demonstrate those things that I've just illustrated. Now, let's look at this. You get, the market was selling. You get, the market was selling previously, as you can see. It's selling, and all of a sudden the market comes and breaks a structure there. You get, the market came and broke a structure over there, so there was a break of market structure there, as you can see. So now, I'm going to bring out the point of displacement. So I can highlight this area as my area or my demand zone. You get, my demand zone. And now, when we reach in this area, chances are high that the market is going to buy. So basically, for me, I may not take the move that is coming down. That's how they get us, unless you're extra careful. This move that is coming down, I may not take it because I'm not really sure. Or possibly I could take it, but then sometimes I could just wait here, and then I'm eagerly waiting to see whether the market buys there. So I can buy in this zone. You get, but then I need confirmations whether this is a valid area for me to buy. You get, whether it is a valid demand zone. So that's why I'm going to bring in the point of displacement. You get, so when I zone out that market, and then I'll be like, I can tell my friend that, you guys, we marked up the zone, and let's wait for a displacement. You get, or an expansion. You get, displacement or expansion. Now this is how I observe. Now, you're going to find that when you mark out those zones, displacement is candles. These are types of candles. You get? So, in this zone of mine, you can see that we have a bearish candle, which is here. Oh, first wait. You get? We have a nice bearish candle. You get? And all of a sudden, we get a bullish engulfing candle. Basically, we have a candle. The next candle came and closed above this candle that has come. In most cases, you're going to find that those candles are in specific regions. You get, already we've tapped into our area of demand. You get, but then what am I saying apparently is that the market creates an impulse. You get, and you can see when the impulse started here, the market was moving aggressively down, and that's what they normally do. They move aggressively, they come, they hit stop losses here, and then they quickly reverse. And now all of a sudden, we can see that we have another candle that closes above it. You get? So there I can say that we've gotten a displacement to the buy side. You get? To the buy side. So which means on the next candle, sometimes this is what normally happens. I can immediately take entries on next candle. Let me first delete this. Uh, Now these things, this is one of the reasons as to why I don't give out signals. You get, because we have different accounts. You get, for instance, this is M15. This is a volatile asset. Personally, I could have the ability to hold a drawdown, because you have to know where to place your stop loss. I could have a setup where my stop loss is just here. You get, I place my stop loss here, and then for me, I've gotten the displacement. The next candle starts. I know when they are retracing, they will retrace at most maybe 50%. You get? So we've gotten a displacement. Now I know the market moves in this kind of pattern. You get? We've moved, we've broken, we have a retracement. You get? A retracement comes, and then we go up. So basically, even in these candles, I know that this next candle may run into this one a little bit, and then we go back up. You get? So displacement, and then you take entries here, and then you go buying. You get? So that's what I was meaning by displacement or expansion. Now I expect the market to be expanding towards the buy side. You get? Because we are from a demand zone. Or we could get displacement. Displacement, these are going to be candles that help us leave an area. For instance, we have this area here. The market is consolidating, but then it's not a normal consolidation where we see the market consolidating going sideways. No. We are seeing the market is consolidating as it goes up. You get? As it goes up. So now, this is the zone. Now, you can see that the market, we got a displacement. We can see that we have this point because we have to know it is consolidating going towards which point. We have this point up here. You get? We have this point up here. And now here, they start consolidating. Now, you look at this move here. You get? You look at this move here. We have a bearish candle and then we have a bullish engulfing candle. Now, we get displacement to complete the pattern. Here they come, they know people are selling here. They see this as a level of resistance. But now they have to first make money before they move the trend. You get? They move out, hit stop losses, and now they start to displace. Now, even in turning, because I have this as my point of interest, my point to sell, but I have to first get confirmations. You get? I have to first get confirmation to sell. Now, what happens? What happens after breaking out? We see we have a bullish candle and then we get a large bearish candle that engulfs. Personally, personally, if I had this point as my point of selling, this is my confirmation. We are seeing the market is expanding to the downward side. And now, for me, I know if at all we've been moving up like that, you get, when we break down, we are going to retrace. To retrace, that's what they call retesting. And now we move down. So, which means for me on this next candle, I know it will come into this one a little bit and then you sell. You get? So I believe displacement, personally, that's how I use it. These are just terms that we use to describe the market. You get? To describe the market. And then if you wanted to sell, you would sell because you know this is your demand zone. So which means at this point, this area here would be your take profit if at all you were selling from this point. So basically, by the you guys, when you learn how to mark up market structure, you get market structure, you can be taking moves because you know now you're taking moves in an impulse and you know you're taking moves in a retracement. Though sometimes retracements are tricky, you get. And I told you those are good for scalpers because you know you're getting in for a limited period of time. And now on that point, I'm bringing out the point of swing trading, the best time frame for swing trading. Let me quickly put it to you. Personally, I believe it's good uh, if you're going to swing trading. Basically, I understand it as trading when you're expecting to hold trades for quite some time, most of the time, at least for a day, but a day or two, but not exceeding, I think, a month. They're what we call position traders, but swing traders, these are long. You're literally trading to hold some trades for quite some time. You get, not just hours. You get. So now, I believe it's good that the way you've seen. Now, this is just a markup. Markets are fractal. You can go on the weekly, even on the weekly time frame, there is a market structure. You get? So you can I normally, for me, if I'm going to take a swing trade, I can start on the weekly to do analysis and then I come on the daily. But so you may not go on the weekly, but you can start analysis on the daily. You go on the H4, you have to have what we call order flow. You get? You go on the H4 to mark up those key zones. Like here, if I'm on M15 and I'm going to scalp off, then I mark up the key areas. This is demand, this is supply. Now, when I come and I react to demand, now I'm expecting to break supply. Now, when you react to this point, if I told you you're buying here, you get, and then you're going to swing trade, then you don't just put your stop loss here. No, you know you this is an impulse because you know the market has moved up, it is retracing, it is going to go further up. You get, and then the point where you expect to turn the market to turn, it means you are going to be clearly seeing it on the daily. You get, you're going to be clearly seeing it on the on the on the daily. You get. So basically that's what you have to be doing. You get. But then you mark up the zones, and then when you reach those zones, you can do some if at all you've marked up, let's say, a chart on the daily, and then you're having something like this. Then when you tap into this zone, you come down on M15, M5, or M1, and you see the market turning. You get, you see the market turning like that, and then you start to place entries. You get. So I believe I've talked about displacement. You get? I believe I've talked about displacement or expansion. You get? You're going to be seeing those candles. Once we start to see, we move down, and then the candle comes, it closes up in our point of interest. You guys remember, it has to be in a point of interest, an area of interest. If at all we get expansion to the upside and then we are in a demand zone, then we buy. If at all we get expansion to the downward side when we are in a supply zone, we sell. That's it for now. I wish you the best and peace.